Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Good afternoon, good morning, good evening. I'm Bill Bymel, The Debt Doctor. I want to talk to you today a little bit about market dislocation. And really, that's the diagnosis I put on 2025 when it relates to real estate debt, and especially in the commercial real estate market. We're also going to talk about why this matters, because it's a little bit of a prediction of some dislocation can be a prediction of future distress. As an introduction, the commercial real estate market, the CRE market, we call it, it's undergoing a period of significant transformation right now. With post-pandemic market dislocations, rising interest rates, distressed asset portfolios increasing, lenders, investors, they're facing mounting challenges. And a lot of this is going on behind the scenes under what's called an extend and pretend environment of lending. You know, I'm pretty uniquely positioned to be able to see what's going on usually before it hits the market. And what I've seen over the last 5-6 years is, especially 5 years since the start of COVID, is crazy increase in the value of real estate. That's not only on the commercial level, but actually on the single family level. We saw 15-20% increases in value over a period of just a year or two. And we saw that consecutively during COVID. A lot of that having to do with the PPP money, the creation of new money that was given to hundreds of millions of Americans, or the tens of millions of Americans that took it, and then went on to spend it on hard assets and some soft assets as well. You know, the dramatic impact of the post-COVID time was Federal Reserve during COVID already was dealing with low interest rates and then drove them further low as to keep a stimulation of the economy. And CRV values really, from what we saw as a result of that, the combination of super low all-time interest rates in 21, 22, maybe even early 23, combined with huge spending. So new leases were being signed. There was a lot of new money being thrown at new enterprises, new businesses. And remember, on the CRE level, you've got value based upon the amount of cash flow those commercial properties were getting in tenants, and or how much people were willing to pay on rent. During COVID, folks were leaving their homes in New York City and renting huge condos on the beach in Miami, and the driving up that demand drove up took what was a dead condo market pre-COVID and then drove it into these fantastic pricing, by the way, which we're already starting to see a collapse of in Florida right now, this summer of 2025. So the perfect storm was created, this huge wave of money, low interest rates, low cost of goods, And it allowed borrowers in the commercial real estate market to get higher leverage loans because there was an falsely inflated value being associated with the commercial real estate because incomes were higher than normal. There was a lower interest rate at that time, whether it was fixed or an adjustable rate. Those interest rates kept the payment down at the time of origination such that they could increase the loan level very close to what this already high valuation existed in commercial real estate. And a savvy investor sold during this huge swell. I think there were gains of 25% annually for multifamily transactions, which peaked at around 400 billion that sold. And then that big wave of money became dislocated because in 2023 we started to see interest rates go up, and all of a sudden that 4.5 cap 200 unit low rise apartment complex in Wichita, Kansas will never sell for a 4.5 cap again. People were paying low cap rates, high prices, high leverage. And now that wave of distress or what we're calling dislocation right now is coming ashore. And there's obviously now an immediate and substantial opportunity for investors to acquire these what's sub-performing distressed CRE assets at a significantly lower value, because what happens is the lender goes bust, or whoever's holding the paper. And that's where guys like us come in and we're able to buy those either from a failing bank or a failing institution or a lender going out of business. The volatility that now exists is kind of just a precursor. I think it's just it just gives you a little bit of a glimpse of what's to come. And so as a result of the reversal in interest rates a few years ago, there's just an obvious reversal and change in the value of certain real estate, namely commercial real estate. And when I say commercial real estate, I'm even referring to residential real estate used as an income source, used as a rental property, whether it's a 1 to 4 family or a 12-unit apartment complex. And so let's talk about that dislocation. That dislocation exists in every home in America, anyone that's an investor in real estate that uses high amounts of leverage. Remember, we're the debt doctor here. So we're talking about distressed debt relates to real estate. I've seen cases these last year or two. I'm hearing more and more of what I'm about to tell you as a scenario happening on a regular basis. Examples of the dislocation we see here in 2025 already. Imagine, doctors. The average borrower in low balance commercial real estate. So what I'm talking about is commercial real estate loans below 5 to 7, $10 million in value. And by the way, a lot of you are out there falling into this class. If you own, 5 or 6 single family properties, you're a commercial real estate investor. And I was very, very surprised earlier this year when I learned for the first time how everyday people are the majority of the investors that are in low balance commercial mortgage real estate. In fact, 73% of low balance commercial mortgaged real estate, that's real estate with mortgages that have a value under $10 million, are actually 73% are owned by single member LLCs or individuals. That's a staggering fact. It's almost as many people that are the investors in single family residential investment real estate, which is over close to 80%. The mortgage real estate market is not an institutional market. The big boys on Wall Street all want to buy the Sears Tower for 10 cents on the dollar. Who wouldn't? And they're all chasing big deals because there's a lot of big commercial deals. Tons of them. Plenty for the big boys and the big money to play in. There's plenty of $50 million, $20 million, $30 million, $150 million mortgages out there to give because real estate has value. There's a lot of it out there, especially in the major metros. I'm talking about all of us, the rest of us. I'm talking about the doctor who bought a medical office building where he has his practice and he has seven other doctors as tenants. I'm talking about a policeman, a fireman who use real estate as their additional pension, as their savings, as their 401k in lieu of or in addition to. So many of you that I've met over the years, and so many of us, real estate agents, real estate brokers, investors, mortgage brokers, lawyers, everyone has their hand in something. And, imagine graduating from one or two single families like my fireman friend from Southern California. He had single family rentals for a number of years. Finally, he bought a 12-unit complex. He bought that about 5, 6 years ago with a 70% LTV mortgage. It was a very low interest rate, 4 or 5%, but even though it was on a 30-year amort, one of the many unknowns for those of you that may not know, and those of you that are investors, of course, you know this, commercial mortgages in general never have less than never more than a 5 to 7 year balloon, meaning even if it's a 30-year amort or a 20-year amortization on the payment, the bank expects you to refinance or pay off that loan through a balloon payment within 5 to 7 years of origination. Now do the math. 5 years ago, 6 years ago, 7 years ago, by both pre-COVID and post initial COVID, interest rates in this country were at an all-time low. So my fireman friend from SoCal got a very low interest rate mortgage at a pretty high LTV. Rents were pretty good at the time, so we had no problem supporting it. But his costs have also gone up in the last couple of years. He got dropped from his insurance carrier in a guy in Southern California losing his insurance. What a surprise. The new insurance carrier, not as good, is costing twice as much. That eats into his bottom line. That eats into his NOI. That lowers the value of the property. So now it's coming time for his balloon payment. And guess what? His value of his property has been lowered. The new mortgages he's out trying to get are not 4 or 5%. They're 6, 7, 8% if you can even get them. And guess what? He lost his equity along the way, lower property value, still has to pay off that 70, 80% mortgage. But he's also got to do so at a higher interest rate that no one will qualify him for at a high LTV. That's the type of dislocation that exists all across America right now. That's the dislocation in real estate. And why it matters is because it's each and every one of you are either going to be touched by it, are already feeling the effects of it, or are going to know someone who is going through some kind of real estate debt dislocation. It's not as gargantuan as the 2008 crisis. Surprisingly and excitingly, the commercial real estate mortgage market is only about a third the size of the residential real estate mortgage market. So when we had the GFC, the Great Financial Crisis of 2008, and 40% of mortgages were looked to be underwater, and you had default rates into the 14, 15, 20% and value declines of 40% in some areas. That was a much bigger market, so it had a much greater effect. I'm not saying this dislocation won't have a huge impact on the economy, on what lies ahead for us in real estate. What I do know is anytime there is dislocation, it presents unprecedented opportunities. If you have the right strategy, you have the right approach. I had plenty of woulda, shoulda, couldas in my life. And going back to the GFC, if I had my druthers, if I had enough money back then to invest, I would have bought, and never sold. My woulda, shoulda, coulda is buy and never sell. And the next go around, the next opportunity to buy, whether it's a cycle, whether it's one off, whether it's an ongoing thing for the rest of my life, my intention is to buy and never sell. I see unprecedented opportunities on the horizon. I've already uncovered and bought and made huge opportunities off of the quieter, unknown failures that have kind of leaked out to the market the last few years. It reminds me a lot of what 2008 felt like in one way, in the way that everyone is sitting around uncertain, uncertain about the times ahead, and knowing that something was going to happen. Now, I, for one, am a person that when I see opportunity, I usually go out and take action and try to figure out, well, how do I benefit from the opportunity ahead? And I'm not saying benefit off of not to do so in a way that benefits off other people's misery. Au contraire. If people are going through a miserable time or dealing with dislocation, it's my knowledge, it's my experience in dealing with that is my give back to the community, back to the situation. So we make our money on the buy. We go out and either help lenders and investors who have loans that are in distress. We will advise distressed borrowers all the time. Our first option is always a workout, try to keep things going. And, in seeing all of what's going on right now, I can tell you the opportunity is increasing, the need for folks that understand what this dislocation is, that's increasing. And you're going to see more and more of this conversation around the world and also here on The Debt Doctor. Thanks for joining. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.